Welcome back again. In our session today, in respect to today's session, we want to talk about deferred tax. We want to look for, or rather get or do one more illustration in respect to accounting for taxes, especially determination of deferred tax. As you must have noticed earlier, we may not have a big problem as far as current tax is concerned. We normally have a problem, or is a little bit slippery, in determining deferred tax expense or income for the year and the deferred tax liability or asset for the year. We have an illustration that was examined some years ago. That is in June 2010, question 2C. That's a question that was examined in one of the CASNEP syllabus in 2010. Now, here we go. Question 2C. Jahazi Group is estimating the deferred tax liability as of 31st May 2010 and has provided the following information. 1. The property, plant and equipment as a cost and a revalued amount of 100 million and accumulated depreciation of 18 million. Total capital allowances on property, plant and equipment amounted to 30 million. 2. The group has available for sale financial assets that were purchased during the year at a cost of 10 million shillings. There was a revaluation gain of 2 million reported in the available for sale reserve. 3. The group spent 50 million to develop a new product, and out of which 10 million has been charged in the income statement as amortization for the year. The balance of 40 million is shown as an intangible asset in the statement of financial position. The full amount of 50 million was allowed for tax purposes in the year. 4. Total inventory was carried at 20 million, which was the net realizable value. The cost of the inventory was 22 million. There was an unrealized profit of 1 million that had not been deducted from the inventory on consolidation. Then, number 5, the receivables amounted to 30 million after making a provision of 2 million for a doubtful debt. The amount also included a foreign exchange gain of 1 million. Exchange gains or losses and doubtful debts are only allowed for tax purposes when they are realized. 6. The trade and other payables of 40 million include an accrual of 5 million, which relates to a pension and other employee benefits to be paid in the year 2011. These are only allowed for tax purposes when paid. 7. The deferred tax liability as at 1st June 2009 was 8.5 million. 8. Assume the temporary differences due to the revaluation of property, plant and equipment amounted to 2 million and the corporation tax rate is 30%. Required. Compute the deferred tax balance as of 31st May 2010 and the charge to the income statement for the year ended 31st May 2010. Now, friends, from the required point of view, we are required to compute either a deferred tax asset or a deferred tax liability. That is the deferred tax balance as of 31st May 2010. Secondly, we are also required to determine the deferred tax income or deferred tax expense. But from the point of them saying the charge to the income statement, then it means we are likely to have a deferred tax expense, not an income. Now, one thing you need to remember, when we are going to, for the purpose of computing the deferred tax asset or liability, we need first to identify the carrying amounts and the tax basis of the assets and liabilities. Then we find out the difference between the carrying amount and the tax base. Friends, the difference between the carrying amount and the tax base is simply the temporal difference. This temporal difference is likely to be taxable or deductible. If it's a taxable temporal difference, it will give rise to deferred tax liability. But if it's a deductible temporal difference, it will give rise to a deferred tax asset. So that's the first two steps that we have to carry out for the purpose of determining the deferred tax asset or liability. Then later, we prepare our deferred tax account and determine our deferred tax income or deferred tax expense for the year. Now, friends, you also need to remember you need to remember there is the tax effect on a revaluation. If there is fair value adjustment of an asset, then we need to take into account the tax effect on that particular revaluation surplus or revaluation gain. We are going to talk about that one once again. Now, from the beginning of the question, we have been told that we are estimating a tax liability as at 31st May 2010. So simply, we are going to compute a deferred tax liability, not an asset. We have been given some information. In note number 1, we have been given about the property, plant, and equipment. We have been given the PP, we have been given the revalued amount, we also be given the accumulated depreciation, we have also been given the capital allowances. That is, the capital allowances is 30 million, while the depreciation is 18 million. You need to remember, friends, when you talk of a carrying amount, it's simply the net book value. This means we'll take the original cost, we subtract the accumulated depreciation expense. But if you talk of a tax base of a PP, in this case, we take the cost, you subtract the accumulated capital allowances, or rather you can call it accumulated tax depreciation. We are going to carry out that. Then number 2, we have been told about the available for sale financial asset. This regard, we have been told that the cost of these available for sale financial assets, friends, was 10 million. But it had been revalued. It had been revalued by 2 million. This means that the revalued amount will be 12 million, and there is a revaluation surplus of 2 million. This revaluation gain or surplus of 2 million will help us to determine the tax effect on revaluation surplus. We are going to work on that as we come back later. Then number 3, we have been told the group spent 50 million to develop a new product. So there is research and development cost, which is normally recognized or capitalized as an uncurrent asset. We have been told that it had spent 50 million, out of which 10 million has been charged in the income statement as amortization. In other words, it has been amortized by 10 million. Up to that point, it means that the carrying amount will be 40 million. So you take 50 million, you subtract the amortization for that year, we'll have the carrying amount of 40 million. Then we have been told, in other words, we have been told the balance of 40 million, which is shown as an intangible asset in the statement of financial position, as we must have said, that's the carrying amount. The full amount of 50 million was allowed for tax purposes in the year. This means that the 40 million, being a carrying amount, is all allowable for tax purposes. But out of the 40 million in the current year, we have not recognized any amount for tax purposes. We have only recognized, out of 50 million, we have recognized 10 million for tax purposes. We have not recognized 40 million, and our carrying amount was 40 million. This means that out of 40 million, the tax base is nil. We are going to look at that again. We come to note number 4. They have told us about inventory. That inventory was carried at 20 million. In other words, it means that's the net realizable value. We have been told the cost of the inventory was 22 million. There was an unrealized profit of 1 million that had not been deducted from the inventory on consolidation. Remember, when we talk of unrealized profits of 2 million, of 1 million that had been deducted from the inventory, in other words, that's a provision. A provision had been adjusted, and any general provision or a provision, as long as it's general, is not allowed for tax purposes. So we are going to recognize that as one of our causes of the temporal differences. We also have, number 5, the receivables. We have been told the receivables amounted to 30 million after making a provision of 2 million. So 30 million is actually the carrying or net realizable value for a doubtful debt. The amount also included a foreign exchange gain of 1 million, and exchange gains or losses and doubtful debts are only allowed for tax purposes when they are realized. You need to remember that those, as we must have said, if an amount will be taxed when realized, or taxed on receipt, or taxed on settlement, then the tax base of such an item is nil. If in the current period an amount or an item will be recognized for tax purposes on receipt, or tax purposes on settlement, then the tax base at the current period for that particular item will be nil. We are going to look at that in the process of determining our tax base. The number 6, the trade and other payables of 40 million include an accrual of 5 million, which relates to pension and other employee benefits to be paid in the year 2011. These are only allowed for tax purposes when paid. Remember, when you talk of the trade and other payables, the amount reported or reportable in the balance sheet is 40 million, and that's our carrying amount. Out of 40 million, there is an amount of 5 million which will be recognized for tax purposes on payment in future. That's 2011. This means that out of the 5 million, the tax base on the same will be nil. It means out of the total now 40 million, the tax base in this case will be 35, and the 5 million will be a temporary difference. Very important. So we have number 7, the deferred tax liability on 1st June 2009 was 8.5 million. That's the balance brought down. And we have also been told, number 8, assume that the temporary differences due to the revaluation of property, plant and equipment is 2 million. Remember, if there is a revaluation of an asset, we'll always use that information to determine the tax effect on revaluation. Okay, the corporation tax rate is given as 30%. Now we go back and use the same information we have explained in determining our deferred tax balance and determining our deferred tax expense. First and foremost, we start with item number 1, 2, 3, like that, in that order. So we are saying this is a question that was done in December. Not December, friends. It is something to do with June. We are talking about June 2010, question 2C. We can subdivide this. So we are saying June 2010, question 2C. Step number 1, we need to determine. Step 1, let's determine the carrying amount and tax base. Thus, compute the temporal differences. Temporally differences. I'll come and talk of the item. I'll say the carrying amount. I'll have the tax base. I'll talk about the temporal difference. Remember, friends, is equal to carrying amount minus the tax base. We can also identify whether it's a taxable temporal difference or a deductible temporal difference. Now, I will start with note number 1. In note number 1, as we have noticed, is property, plant, and equipment. This is property, plant, and equipment. Our figures are in millions. Our figures are in millions. Our figures are in millions. Now, in note number 1, we have been told property, plant, and equipment as a cost and a revalued amount of 100 million and accumulated depreciation of 18 million. Total capital allowance on property, plant, and equipment amount to 30 million. The carrying amount is simply the net book value. So we'll say 100 million, you subtract accumulated depreciation of 18 million. How much will that come to? So if we take 100 million, you subtract 18, we have 82 million. Then we have been told the same note number 1, total capital allowances on property, plant, equipment amount to 30 million. For the purpose of the tax base, for an asset that is depreciable subject to capital allowance, then the tax base is simply the written down value, which in this case will be 100 million. You subtract the 30 million, and that comes to 70 million. Now, the temporal difference in that case, friends, will be 12 million. Since the carrying amount is 82 million, the tax base is 70 million, it means there's an excess of 12 million, which will result to more economic benefits for tax purposes in the future. So this 12 million is simply taxable temporally differences, is a taxable temporally difference, and it will give rise to deferred tax liability. We talk about note number 2. In note number 2, the group as available for sale. So we are talking about simply available for sale financial asset that were purchased during the year at a cost of 10 million. There was a revaluation gain of 2 million reported in the available for sale reserve. Because if we have revalued this asset, we always recognize the revalued amount in our balance sheet, because we don't depreciate this type of assets. So it means that the revalued amount is actually what was reported directly in the statement of financial position. So the carrying amount is simply 12 million. But for the tax purposes, we recognize the original cost. So we recognize the cost of 10 million, meaning the temporal difference is 2 million. And in that case, this becomes a taxable temporally differences. We move on to number 3. The group spent 50 million to develop a new product, and out of which, so this is research and development. Note 3 is research and development. We have been told that it spent 50 million, out of which 10 million has been charged in the income statement as amortization for the year. If the cost is 50 million, the amortization is 10, simply the balance remaining or the book value is 50 minus 10, and that is the 40. In fact, we have even been told the balance of 40 million is shown as an intangible asset in the statement of financial position. So the 40 million, friends, is our carrying amount. Then we have been told the full amount of 50 million was allowed for tax purposes in the year. Remember, in our carrying amount, we don't have 50 million, we have 40 million. If we had 50 million, then we could say that out of the total 50 million, we have only recognized 10 million for tax purposes, and the other is the temporal difference. But in this case, our carrying amount is 40 million. After adjusting for the 10 million. So we can say that out of 40 million, we are not going to recognize anything for tax purposes this year. The 40 million will be recognized for tax purposes in future. This means that in this year, out of 40 million, the tax base is nil. Then our temporal difference will definitely be 40 million. This means this is a taxable temporally difference. The next item is number 4. We are talking about note 4 now. In note number 4, total inventory was carried at 20 million. So in simple terms, we are talking about inventory. Inventory was carried at 20 million, which was the net realizable value. Normally, we recognize the net realizable in the statement of financial position. Simple. That is our carrying amount. So the carrying amount is simple, 20 million. We have been told there. Then we have been told that,